Hello again, everybody. I'm Kevin Pierce with Caldez Financial. Thanks for joining us again for part 3 of borrowing or lending against accounts receivable, factoring, and also asset-based lending. We're here with Robyn Barret, superstar asset-based lender and factor extraordinaire. Thanks for being here with me again today.
Awesome. I'm glad to be here.
All right. Well, we've talked a lot about the mechanics of factoring deals. Let's talk about the same kind of subject matter, but as it relates to asset-based, where you're lending on a portfolio of receivables. And let's, for the sake of argument, let's take inventory out of it because that's more complex. But let's talk about this $1,000 invoice. So I'm a business, I build Honeywell, so maybe instead of 1,000, maybe it's 100,000. Okay, and it's to Honeywell and a myriad of other borrowers or account debtors, because now we're talking about ABL and it's basically being reported as a summation of all the accounts receivable. So take us through how that works. I send out a bunch of invoices one day and I send you kind of an accounts receivable aging, and it shows that I've got $100,000 of eligible accounts receivable. So take me through how that cycle works and how it's different from factoring, if you could.
Yeah, so there's a couple of different ways we can set up an ABL line, but we'll just take it as a pure ABL line.
Okay.
So it's not going to be invoice by invoice based. So you need to borrow money today.
Right.
You're going to send us your whole AR aging.
Right.
Okay. We're going to upload that into our system, and we're going to calculate ineligibles, and we talked about those: contra, concentration, over 90 days. And so let's assume it's $1 million. You've got $1 million of AR and a bunch of different clients.
Okay.
And you've got ineligibles of 200,000.
Okay.
So that means you're going to have eligible AR of 800,000.
Okay.
And then let's assume that the advance rate is 80%. I call you up, or I tell you, I say, hey, Kevin, great news. We ran all your numbers through, and you've got $640,000 that you could borrow from today.
Okay.
And you're like, fantastic. So let's say you pull all of that down.
Okay.
Okay. Now, the way it works is, so you pull it, now you have zero availability.
Right.
Until one of two things. Two things can happen. One, we get cash payments.
Okay.
Once we get the payments in on those receivables, then we apply that to the loan balance.
Okay.
So let's say next week we have received $400,000.
Okay.
You call up and you said, hey, Robyn, what's my availability? I'm like, well, here you go. We got $400,000 worth of payments. You can borrow, now you've got $400,000.
So I borrowed $640, and the payments have been coming back to you.
So they pay it down. Yeah.
So it automatically pays down the line. So now I'm only borrowing $240.
Yeah, $240. So, and then what happens? So what happens is the payments, like in factoring, the payments are actually going to the actual invoices. That's how you post them. In ABL, it's just at the loan balance.
Okay.
So then you now say, I've got new sales. So there's two ways you could do it. You could, one, just send us the sales for that period.
Right.
Or you could send us a whole new aging.
Okay.
And then what we do is we put that aging in and we match it to the previous aging.
Okay.
And then we also then make sure that we've, that whatever's dropped off, we've collected in cash. So you go through a whole reconciliation process.
Right. So my first week it was $1 million, and then I borrowed against that $1 million. Some of that got paid, so I get the availability.
400,000 came back. Yes.
Right. So then I've
240.
made more widgets, and now I bill more. So it's a completely revolving cycle. But instead of it being on one invoice and then the next invoice and the next invoice, it's the whole portfolio of receivables as a whole, as opposed to just one invoice or two invoices or three invoices.
So and then that is correct. And the difference too between factoring is asset-based lending is more of a borrowing base. So some of our clients that we do ABL with, we calculate the borrowing base and we send it to them.
Okay.
And then we have some clients that calculate their own borrowing base and send it to us, and then we just basically verify the numbers.
Right.
So there's again, it's on that spectrum of risk.
Right.
So the less risky you are, then you probably are going to do your own borrowing base. We'll send it in, and we're just going to check it off.
Okay.
The more risky it is, then we're just going to have you send your AR in. We're going to do a whole reconciliation. We're going to calculate ineligibles, and so it just depends in that sense. Also, ABL is less intrusive than factoring. Most of the time with ABL, we as our shop, we still do some verification. So we may still reach out to the debtors, or we'll have the client reach out to the debtors and copy us on emails. So we are still doing that type of verification, versus like a bank, which the bank is never going to reach out to the debtors to do a validation.
Right. So instead of every invoice, it's going to be a sampling, maybe major invoices, or maybe over a certain threshold of invoice size or something like that.
Yeah. We also sometimes will sample and say, if they sent in $1 million of invoices, we may sample and say, send us 5 invoices with their backup, just to, again, so we're always kind of doing those mini audits as we're kind of going through.
Okay. Now, we talked in factoring about how you price on a fee basis, right? So we took the example of the $1,000 invoice and how that's going to cost me $20. So on an ABL deal, I'm imagine since it's not invoice by invoice, you can't price an invoice by invoice. So how do they price asset-based lines, and where do you see the market today in terms of how, say a bank ABL would be priced versus a non-bank?
Yeah, so how do we get paid?
Yeah,
okay,
right.
so you're right. So again, with factoring, we earn our fee every time a payment comes in.
Right.
With ABL, you basically are, all those transactions are happening all month. They're sending us AR, we're getting payments, we're giving them advances. So the loan balance is going like this.
Right.
At the end of the month, we run a loan statement, and then we charge them the interest rate, and it's usually a daily balance that totals up to then here's how much you owe for the month.
Okay.
Pricing is always going to be either a prime based or a LIBOR based. I know LIBOR is going away soon, but they don't have a replacement yet. So it's going to be prime or LIBOR based plus base. Usually, again, if it's prime based, it could be anywhere prime plus 2-3% to all the way up to 11 or 12%.
Right, depending on the risk profile. And typically riskier deals in the ABL world, you have sort of a different cross-section of different types of lenders in ABL. You've got bank-affiliated ABL like the Wells Fargo's, even the Alliance Bank, who owns Bridge Bank. So those are bank-affiliate ABL, so they have a lower cost of capital themselves. So they're able to take on deals and compete based on price. However, because they're affiliated with banks, the trade-off is that there's more regulation, there's more Patriot Act stuff on the underwriting, and they have to stick closer to sort of the regulatory basis under which banks are allowed to lend, because it's just more regulated. Once you get outside the regulated environments, we'll talk a little bit more about this with Cliff Moshnick when we talk in more in depth on inventory. But once you get outside the regulated environment, those lenders have a lot more sort of leeway in terms of the amount of risk that they can take, and thus, what they can charge for these deals. And so I guess I would say that on the risk spectrum, it's always the riskier the deal, the farther outside the bank channels you're going to have to go, and the more you're probably going to have to pay for the money, just simply because their cost of capital is more expensive and they're taking more risk.
Correct. And it's funny because you brought up like the regulation. So sometimes we can be very competitive, but we have different ways to be competitive. We can be competitive because speed, right? We can be a lot faster than maybe a bank can. So it depends on where that client is.
Yeah, I've seen you guys get deals done in like a week or two.
Yep. We closed a $6 million deal a year ago that had some inventory component to it, and we closed it in a month.
Oh yeah,
so
that's terrific,
great.
Especially when you include inventory, because it's a lot more complicated with inventory. So that's pretty good.
Yep.
Yeah. All right, so we've talked a lot about the details of factoring, and we've sort of contrasted and compared with asset base in terms of once the deal has been onboarded, how it works. Well, let's talk about how you find a new factoring company or a new ABL company. And maybe we can draw some distinctions as we go into that. But basically, in my experience, there's usually about a 2-step process when you're looking for a new lender and maybe moving from a bank into a factoring arrangement or whatever the case may be. But generally, there's a screening process where you may be talking with a number of lenders, and they'll be issuing term sheets based on initial data. They scrub the data and they say, okay, here's what we think we can do for you, and they issue a term sheet, and then you pick one of the term sheets, the one you like the best. Hopefully it's based not on pricing but on relationship and based on borrowing need, but you're going to have your own criteria. Now you have signed a term sheet and you're into formal underwriting. So Robyn, take us through what happens then before you become the lender of record, but after you've issued and received a signed term sheet. And take us through both the factoring and the ABL, and let's see if we can discuss a little bit about the differences in the process of
Sure.
underwriting.
So just the due diligence.
Yeah.
So once we've got the term sheet back, then we can really kind of start digging in. I'm going to talk about some things that are always the same. You're going to do a UCC search, a lien search. So those things you're going to do with any lending. So
Right.
it's one of the first things we do, because that really dictates how your due diligence is going to go. Because if you've got a deal that's pretty clean and there's no UCC filed, there's no lawsuits or whatever, then you're like a pretty easy deal.
Right.
If you've got 3 lenders, and then you're like, okay, now we got to worry about who's going to subordinate, who's not.
Intercreditor agreements.
Intercreditor, and if they're not going to subordinate, will there be enough collateral to pay them off?
Right.
So you have all this. So those are the same discussions, whether it's factor or ABL. So once you kind of get past that, on the factoring side, we start digging into the debtors.
Right.
So we start digging into, okay, how much are they selling to them? What are their sales projections? Because we want to look at sales projections, because they may only be selling to Bob's like truck sales down the street,
Right.
and they only did 10,000 this year. But what you don't know is that what they're planning to do is sell 600,000 to Bob's next year.
Right.
And you may say, well, we can't credit approve for that amount. So we like to work with our client and say, okay, so here's where you are today. Where are you going to be tomorrow and the next day? So let's make sure that we don't have an unpleasant conversation 6 months down the road.
Surprises.
A surprise.
So you got to be forward-looking in your underwriting.
So we are very forward-looking. So and you know what? Some clients are really good with projections, and some are not. I mean, they don't know what's going to happen tomorrow. Those are usually your factoring clients.
Right.
Yeah. So with the factoring, we do the searches, we dig deep into the debtors. And then we also look at how they invoice. We want to make sure that their invoices have the invoice number on them, that they have the, how detailed are their invoices? And then not only that, what kind of backup do they have with their invoices?
Right.
The other thing we spend a lot of time doing with the factoring side too is that we're looking at the contracts. So let's say you're a staffing company and you've got an agreement with IBM, right,
Okay.
to staff.
Right.
We actually go through there and we look at the contracts to see what type of insurance you need to have, and is that what you have?
Right.
Is there any certification? For example, like guys that are working on the cell towers, they're only certified to go up so many feet.
Really?
Yeah.
Oh.
So that will be in the contract. So
Okay.
if you don't read the contract and your client is having guys climb up above what they're certified, that's just going to be an excuse for your debtor not to pay.
Right.
So in factoring, you're kind of always looking for why the debtor might not pay.
Right.
So, and then how do you invoice? It's very particular, especially like big retail, TJ Maxx, Costco. If you don't send your invoices by EDI,
Okay.
they're not going to pay them.
Okay.
So we usually go through the contracts with a fine-tooth comb. And the funny thing is, like we talked about, we're kindergarten sometimes. We go back and we tell our borrowers, you know what? We saw your backup. It's not actually fitting what's in the contract.
Right.
So to go forward, this is how you're going to have to invoice. So we spend a lot of time with our clients making sure that what their contracts or agreements or purchase orders say is how they're actually invoicing, or the insurance or certification and stuff like that. So that's a lot on the factoring side. And we do look at their financials. I would say usually smaller businesses like that, they're probably not worth the paper they're written on.
Right.
When you have liability accounts that are negatives,
Right.
then you've got a problem.
Yeah.
Right.
Yeah.
So
I see that all the time.
so you pretty much just go out the window
Yeah.
with that. So again, that's the factoring side.
Right.
On the ABL side, we still review contracts, not to the extreme, because really those clients are a little more sophisticated.
Right. Right.
Like I said, they've got the accounting processes in place and the procedures and all that. So with the ABL, you start again with the searches. What do we have to deal with here?
Right.
And then we look at their financials. And for example, I was looking at a deal today, and this was going to be an ABL deal, a little bit of a workout deal. And the group sent us their projections, and so I kept asking them more questions about the projections. I need to know more information on your sales. And they give me these sales numbers. I'm like, okay, so anybody can create a sales number.
Right.
I need backup. So how are you getting to these sales projections? And that's really helpful when your borrower can say, you know what, we built our projections based on, and then you're listening based on what? Do you have purchase orders? Are you looking at historical? And again, little asterisk, it's a little hard right now to base projections on historical because 2020 was
what are you going to be? There's no basis, right?
So this client, we had to keep going back and forth about, we really, we need some, and they were in a manufacturer. They make belts, belts for clothing, and so we were really digging deep, getting into their projections. And what's interesting is we turned the deal down. We sensitized their projections, and so we said, okay, if you missed sales by 20%,
right,
30%, 40%, what happens to your cash flow? And this company, if they missed their sales by 20%, they were losing money in a big way.
Right.
So I'm like,
which just eats away at the availability. Again, one of the primary differences between factoring and ABL, that when you're underwriting, you have to underwrite to the viability of your borrower,
the cash flow,
as opposed to just the account debtors.
Yeah. Because again, in a little bit of what's scary about that was, like you said, in the factoring, if you buy an invoice and the client goes out of business, you're pretty much going to collect on the invoice.
Right.
In asset-based lending, there's a lot of moving parts and everything moves so quickly.
Right.
If you've got a client that all of a sudden is deteriorating, and now let's say they're making belts, and because they're losing money, they go and their vendor turned them off. They go to another vendor, and that vendor's making a lower quality belt. Well, all of a sudden you're going to have a high amount of returns, chargebacks, and dilution goes up. So that's why in an ABL, we are kind of looking at some of those things, and we're looking at the monthly trends on the financial statements, on an ongoing basis. But on the due diligence, we spend a lot of time going through their forecasts. Where, so you had a hiccup or you had some issues, you're talking to us because you're not bankable.
Right.
Let's talk about what the issue was. Let's talk about where you're going. And, I'm not, unfortunately, going to just take your word for it. You got to give me some real proof.
Right. All right, Robyn. Well, thank you so much for being here. I think it's been great. We've covered a lot of ground over these different sections of this episode on accounts receivable financing. Thank you for being with us. We hope you've enjoyed this. We hope it's been informative. My name is Kevin Pierce. I'm with Caldes Financial. You can reach me on the web at www.caldesfinancial.com, or you can email me directly. I'd love to hear your feedback. My email address is kevin.pierce, P-E-A-R-C-E, at caldesfinancial.com. And Robyn, Barret, we hope that some of the viewers will reach out to you directly. Perfect. Certainly you have a great product and great expertise. Congratulations again on being named one of the top 100 women in ABL. I think that's a wonderful distinction, and I'm honored to have you on this. Thanks very much for what we've been talking about over these past 3 episodes.
It's been great, and I'm honored. Thank you.
Thank you, Robyn.